So let's start. My project was about building a systematic J10FX index, which I'll be explaining to you right now. But first of all, we need to have the necessary legal disclaimer just to say that this presentation is only for informational purposes. So please don't go and live trade anything that will be explained here. Okay, so now let's go. What this project is all about? The aim of this project was to build an index that could be used as a benchmark, okay, to proxy the G10FX market performance and in a systematic way. And that's a fantastic phrase, but what does it actually mean? And the point here is that if I ask you what was the S&P 500 returns on 2020, it's actually easy. You go online, you download the data, you do all your calculations, and you can conclude that approximately you had a 16% return on capital during this year on this asset or this instrument. But if I ask you what were the FX returns on the G10 countries in 2020, that's a tricky question. That's not a trivial question to answer. And what I will try to do is to try to answer this question actually. And the goal here is to build an index that any investor could try to use a benchmark to proxy their own performance. Okay, so how can we build an FX index? We can build it, for example, using factors that drive the FX market returns. And one of these, or actually three of these factors could be, for example, the interest rate, so the carry trade, which means, or the underlying hypothesis is that higher yields drives market returns. Then we could use the law of one price, like a value factor related to purchasing power parity. And you will see that this it's something similar like a mean reverting strategy. And finally, the momentum hypothesis, which basically says that if something went up, we assume that it will continue to go up. Okay, so my focus on this project was on the third one. First of all, because it's the easier one, and this is always fantastic. Secondly, is because we don't need any external fundamental data. And this is also great because fundamental data is complicated. You have firstly to obtain it. Sometimes data vendors or the people who publish that fundamental data like to revisit this data and change it over time. So if we download a data set now that has been revised, we won't be using the data that it was actually and really available in that moment in the past if we backtest this strategy. And finally, because the project was extremely too vast for IPAD's schedule, and so my project manager don't get crazy on me. So that was the main reason why I was only focusing on the momentum hypothesis. Anyway, I will be explaining these three factors. So this presentation, or at least you can have new lines of research to try this on your own, which I think it could be okay, or at least great. So let's go with the first one, the interest rates and the carry. Okay, first of all, interest rates, which is our hypothesis here? Okay, it's that higher yields drive higher returns. And this is in theory, because as you might expect, markets are extremely complex and lots of variables are playing at the same time. And just making an only statement that will drive returns, it's quite difficult. And the carry could be just one of the things that explain those returns. Okay, so what are the reasons, or what is a possible reason why these interest rates, this carry trade might work? First of all, you have to imagine countries like, imagine you are in the desert and you are extremely thirsty, and there's one country that gives you one bottle of water, and there's another country which gives you 20 swimming pools. Okay, of course you will go to the second one, and that's like our metaphor here. You will want to go to a country that gives you the higher interest possible. And countries with higher interest will be attracting international investors. Okay, if I'm an international investor and I want to invest in that country that gives me higher yields, first of all, I will need to buy the domestic currency. So I can deposit it in a bank of this country, so I can earn, I can earn the deposit rate. So I'll be buying this currency and the currency will appreciate. But there's one tricky thing in the FX markets is that you can't actually buy one currency without selling another one first. So if I'm intelligent, I can try to go to a country where the lending rate is lower, so I can borrow money from that country and use it to buy the other country's currency. So I'll be using this currency to buy the higher yielding currency, which makes I buy the high yield and I sell the low yielding. So with my trade, I'm making that this exchange rate changes, sorry, and this is the factor which we would be trying to exploit. Okay, so the next one, the value factor. Here, the hypothesis is based on the law of one price, and this is sadly making too many assumptions. Like, for example, there's no shipping cost, and I'll be explaining why this happens. Okay, this hypothesis, how does it work? So imagine that you are in London and you, I don't know, you like chocolate and you buy a cup of hot chocolate, which costs you £1 sterling. Okay, so this same exact product costs 1.5 Swiss francs in Zurich. If you assume that both countries have the same purchasing power, you could expect that the exchange rate from the sterling pound versus the Swiss franc could be that 1.5 Swiss francs. So 1 sterling pound buys 1.5 Swiss francs. But then you go to the real market, you open your terminal, and you see that the current sterling pound versus Swiss franc is about 1.27. I checked this yesterday. Maybe today is higher. So you see that the market is pricing this the British pound versus the Swiss franc at 1.27, but your value model says that this exchange rate should be 1.5. So what can you do? So you can buy you can buy sterling pounds and you can sell Swiss francs. So you will be long the exchange rate pound sterling versus Swiss franc, because what you do is expect that this exchange rate self-adjusts in the future and reflects that imbalance, okay, in value. And as you might expect, this is a mean reverting strategy in which the average or mean price would be that 1.5, and now we are below this price, so we would expect to buy this currency pair. And finally, the momentum, which is the factor that I was using to conduct this project, is like the more straightforward of the three. And the hypothesis is actually very simple. If prices are trending up, you can assume that they will continue to trend upwards in the future, which doesn't mean that this is true. Actually, more times than not, it's not true. But when it does, you can use and ride this trend and try to harvest higher profits than the ones that you don't do when this hypothesis doesn't actually holds true. And this one, this is an interesting factor. It's been very studied in academia. It's a factor that it actually exists, and there are some possible reasons which I think I can understand, and that's one of the reasons also why I like to trade momentum strategies, because or at least I think I understand what drives them. And the first of all is, like, for example, mutual funds and hedge funds rebalancing their foreign positions, so they have to currency hedge their overseas exposure. Okay, what does this mean? Imagine that you are an American-based fund and you want to buy European stocks, for example, German stocks. German stocks are sold in euros or are denominated in euros. So you, first of all, need to buy euros in order to buy this stock. So you are long euro. And therefore, you should sell euro to hedge your overseas currency exposure. Because what might happen if you don't do this? Imagine that you win 20% on that German stock, but at the same time, the euro falls 20%. So if you're not hedged, all the profit would have actually disappeared due to the currency risk. And this heavy rebalancing and heavy hedging can drive momentum, which we can try to exploit in a systematic manner in our favor. The second thing is, or the second possible reason could be the behavioral finance, like some sort of psychological bias, for example, following the crowd, overcrowded strategies, things like Tesla or Bitcoin, that when it's starting to go up, people like crazy start to buy again, and this creates more momentum that maybe you can use in your own benefit again. And the third one is the momentum persistence, which this one comes from physics and is actually saying that if something is moving in one direction, it will need more energy to change or stop that direction than to keep moving in the same direction. Okay, so that's all the theory. Now let's try to get our hands dirty and explain exactly this strategy. Okay, we have talked about these factors, and let's do with the momentum factor. How can we exploit this momentum factor? So, for example, we can buy the currencies with positive returns, and we can sell those currencies with negative returns. And this is actually time series momentum strategy applied to the G10 pairs, currencies. So, for example, we can buy the currencies with positive 6-month returns. And why 6 months? It's simple, just because it's half a year and this looks sensible. You can actually do it with 12, with 8, with quarters, with 3 months, wherever you want. That is not a problem. Just that we are facing a future strategy in which we need to enter some parameters. The least parameters, the best, to avoid overfitting. And if we try to use parameters that may look sensible to us, so this can help us understand better the strategy. And just to be sure that we are not putting, for example, 3 spot 14 months, which would be kind of weird, for example. And again, we will try to rebalance our portfolio once a month. Again, this is because once a month looks sensible, because this will involve fewer trading costs. And this is actually very important because we can't predict future returns, but what we can predict are actually costs. So if we can keep costs at the minimum, this will help us harvesting our returns. Okay, so as I mentioned, we will be using the G10 currencies, which are the euro, the sterling pound, Swiss franc, both the Norwegian and Swedish krona, the Japanese yen, Australian dollar, New Zealand dollar, Canadian dollar, and finally the US dollar. But of course, this selection have pros and cons. Which are our pros here? These currencies are very, very, very liquid, and this means that they are cheaper in terms of spread. You know, at more liquidity, the lesser the spread. But this has a very sensible problem too, that these currencies, because they are so liquid, they are actually less volatile than emerging markets. And as you may know, as traders, what we want is volatility in order to make money, because that's our, or at least this should be our goal. And if you buy one currency pair at 1 and you sell it at 1, of course, you haven't done anything, but just making your broker richer, which is not what we actually want. So pros and cons. And again, we will be using the USD as the quoted currency. So the one on the right, okay? For example, the euro dollar. So the dollar is the quoted currency, the one on the right, because this way we can easily compare the returns. That's just the reason. Nothing fancier than this. And you, of course, could also choose another one. For example, if you're based in Spain, as I am, or in Europe, or whatever you want to live, you can use another currency. For example, you can use the euro as the quoted or whatever. Okay, so now let's start working with the data and try to start to see some more interesting things. First of all, we'll be using monthly data because we are rebalancing our portfolio monthly. It's sensible to use monthly data. Of course, you can use minute data, hourly data, or even tick data if you want more granularity. But for the scope of this project, using actually monthly data was more than enough. And the data range was from August 2003 until December 2019, which I updated actually yesterday to April 21 to see like a forward test to see how this strategy would actually have been performing during this special year that we have had with the corona and all this stuff. Another important thing, actually we have 2 degrees of freedom, which are the rebalancing period and actually the time window, which is 6 months. But we will be we won't be optimizing these degrees of freedom. These variables, sorry. So actually there will be no optimization. So all the data set will act like an authentic out of sample data set, which means, and this is very important, that we won't be cheating ourselves. And we have just one change, okay? If we don't like the results, I'm sorry, that's what it is. But if we use all the data set and then change the results, we've converted our out of sample data set to in sample. So we are introducing overfitting, and this is the worst thing you can do if you expect to make money in the markets, especially if trading systematically. And the other thing is that, as mentioned, we will be using the USD as the quoted currency. And there are other pairs like the dollar yen, for example, which the USD is actually the base currency. So we need to convert all these pairs to our standard format. This is actually easy with this formula that you have here. It's just making the inverse, okay? So now we have the data, we have our parameters, we have all the data quoted with the USD at the right, and then the only thing that we have to do is to calculate the log returns, okay? And why log returns and not normal returns? Just to make sure that we take any compounding that could be inherent in the time series, okay? So because when we rebalance, if we make any profit, the idea is to reinvest all the profits that we're making. So we are actually benefiting of compounding interest. And again, now we have all the returns calculated. And the only thing that we need to do now is to buy the currencies with positive returns over the 6 months, sell the ones with the negative returns, and hold them for 1 full month. And now finally, let's see some plots and some interesting things. And now here we can see actually the individual currency returns against the USD. So that was the reason why we were using the USD as the quoted currency, because now we can compare easily all the other currencies. We can see the euro on the upper side with the New Zealand dollar on the other extreme. What you see here is the white and this. I don't know if you can see my mouse, but well, that wasn't expected. The blue part at the right was that period from 2020 until present day, and the other one is all the data set. But I actually separated it with 70% and 30%. Sorry, 66% and 33%, just to have a reference. But as I mentioned, all the data set would be out of sample, so just forget everything about these blue colors. And now let's see the returns of this strategy. It's important to bear in mind that this strategy was computed without costs, okay? Because it's hard to again to go to the past and grab all the interest rate differentials to compute the swap cost, okay, the interest rates cost. And this would be an important cost in our strategy because we are maintaining open positions during 1 month. And in the FX markets, you are charged with the swap, which is called each night. And actually on Wednesday, you are charged with triple swap. So this would be a very important cost that, of course, will drag our returns down. Again, we haven't included any brokerage commissions nor slippage, but in this case, we can expect that slippage would be a small cost because our small trading and our small frequency. Okay, so now, what does this chart tells us? At least it tells that the backtest is profitable, which is no guarantee that the future will be, but we can see 2 straight vertical lines upward, which always it's beautiful to see in a graph, which correspond to high volatility periods. Actually, I was expecting that this strategy performed much better than it did in this period from 2020 until now, because as everyone knows now, we have been through a very volatile year, and momentum strategies are expected to perform well in volatile years. So what could have happened? Maybe we were introducing overfitting just by using this factor, which some other people have told that it works, and this is an implicit form of overfitting. So it will be great to monitor this strategy in the future, but I was just expecting to have a surprise this 2020, but I had not. So I'm sorry, guys. And on the right side, we can see the distribution of returns of this strategy. As is a momentum strategy, we can actually see how we have positive skew, which was actually expected. And finally, this was actually a great project. I enjoyed it a lot. And it was a great opportunity to research and learn about that factors, what drives the markets, and even to drive more in depth to working with real financial data sets and also facing the problems with fundamental data sets which are not included in the price. And again, our conclusions could be that momentum strategy performs well in volatile periods, but not so well during not volatile ones. We had seen our positive skew of returns, which was something that in theory was expected. Again, we have seen that in this 2020 year period, the strategy was not performing as well as we could expect. And finally, we could use this kind of strategy if we have an existing portfolio and we want to add a hedge to it.